Welcome to Virtual Wisdom Finance and Accounting Tutorials. My name is Peter and I'll be your guide in this particular tutorial. In this tutorial, I want us to look at how to prepare a balance sheet. A balance sheet is also referred to as a statement of financial position. The reason why it is called a statement of financial position is because it tells the position of an organization at a given point in time in terms of assets, liabilities, and capital that particular organization is holding at that given time. For example, if we say this is the balance sheet as at 31st, it means as at 31st, our position as the organization is as per the balance sheet that is presented. For you to be able to prepare a balance sheet, you must understand the accounting equation. Accounting equation, or what we call the bookkeeping equation, it states that at any given point, the assets of an organization will equal to the sum of liabilities and the owner's equity, or what we call capital. In other words, assets equals to capital added to liabilities. And as we are going to see, an asset, let's start by looking at an asset. An asset is a resource that is owned or controlled by the company. Whatever that belongs to you as the owner of the business, that is what is called an asset. And assets are divided into two categories. We have non-current assets, or what we call fixed assets, and we have the current assets. So we have an asset divided into non-current assets and current assets. Let's start by discussing what non-current assets are. Non-current assets or fixed assets are those assets that are not easily convertible into cash. You cannot convert them into cash easily. They take time for you to be able to convert them into cash. For example, a building. Before you convert a building into cash, it will involve a lot of paperwork, a lot of processes, and therefore it takes some time before it is converted into cash. On the other side, current assets are those assets that are easily convertible into cash. For example, cash itself. Cash itself is already in form of cash. Cash in the bank account is in the bank years, and the only procedure to make it cash is to go to the bank and withdraw. You can see the process of turning it into cash is very simple, and that is where they are referred to as current assets. The other item, before we go to the other item, we need to look at some examples of non-current, or what we call the fixed assets. We have land and building. We talk of land. This is the physical land, the soil, the buildings. This includes the structures, plant and machinery. If it is a manufacturing entity, a plant is that place where you do the operation, where you do the manufacturing, where the machinery is set up in. Then we have machinery itself, the machines. We have fixtures, furniture and fittings. We also have motor vehicles. So all these items are not easily converted into cash. On the other side, we have current assets. Current assets include something like stock, inventory. Stock is what you are dealing with, whatever you are selling. For example, if you are selling an example, maybe you are selling electronics. The electronics there are your stock, are your inventory. Then we also have debtors or accounts receivable. These are the people whom you have given goods on credit. You are expecting payments from them. Those are your what? Current assets. We also have cash at bank. This is money stored in the bank. Cash in hand is the float, the money in form of cash that you are holding. Prepaid expenses. A prepaid expense is when you make a payment for an expense in advance. For example, something like airtime. When you go to the shop, you buy airtime. Before you consume that airtime, you have already spent some money for it. You have bought it. So that airtime still belongs to you until the time you consume it, until the time you call, until the time you use it. Therefore, it is a prepaid expense. Something like KPLC tokens. You buy the token, but before you consume, you have not received the services. The services, you get them after consuming it, and therefore that is a prepaid expense. Then we have what we call accrued incomes. Accrued income is, for example, you have worked in an organization, then they have not paid you for the month that you have already worked. So that money is yours because you have already provided the services and you're expecting to be paid. And because it is your money, that is why it is falling under current assets. The other item are the liabilities. Liabilities, on the other hand, it is what you owe to other people. Whatever you owe, liability is like a debt. Whatever you owe other people, or the liability, you can also call them creditors' claims on the company assets. That if the company was to be wound up, if it was to be liquidated, if it was to be closed down, what percentage of the assets would you use to pay the creditors? Creditors are the people you owe. Those are the liabilities. Liabilities are categorized again into two. We have non-current liabilities and we have current liabilities. So again, if I take you back to the bookkeeping equation, we have liabilities as non-current liabilities and we also have current liabilities. Under that, non-current liabilities are those liabilities payable in a period longer than 1 year. If you take a loan that is payable in 2 years, 3 years, 10 years, 20 years, those loans are non-current liabilities. Then we have current liabilities, liabilities payable within a year. Anything that is payable in months, a loan that is payable in months, like a bank overdraft which is payable in a period of not more than 6 months, that is a current liability. That's how you differentiate between non-current liabilities and current liabilities. We can give some examples. Non-current assets include, we have a 10-year loan, we have debentures. Debentures, this is money borrowed from the public by a company, which are payable in a period of more than 1 year. On the other side, we have current liabilities, a bank overdraft. When you withdraw more than you have in your bank account, if you go to a bank and you have 2,000 shillings and you're in need of 3,000 shillings, the bank can allow you to withdraw. That is, if you qualify for an overdraft, they will allow you to withdraw 3,000, but the extra 1,000 is an overdraft. You are withdrawing more in excess of. That is what it's called, an overdraft. The same way, let me use an example of M-Pesa. Nowadays, we have what we call Fuliza. Fuliza will allow you to make payment with an amount higher than what you have in your M-Pesa. That is an example of an overdraft. You are using more money than you have. Then we have creditors, or the accounts payable. These are the people you owe, your suppliers, when they sell goods to you on credit so that you can pay them on a later date. Those ones are creditors. Then we have prepaid income. Prepaid income, this is when you are paid before you provide services. For example, in your place of work, if you ask for an advance, you are given an advance, yet you have not worked for that advance, so you owe them. In any given circumstance, if you leave the organization, you'll be required to refund that money because you have not provided the services. That is why it is a liability. It will only be yours once you provide the services. Then we have an accrued expenses. Accrued expenses, these are expenses carried forward. For example, if you use an example of water bill, you pay for the bill after consuming the water. You have consumed the water, then you're given the bill and you pay for it. So before you pay for that bill, that is an accrued expense. It is a liability because you have already gotten the services. You have already consumed the water, but you have not paid for it. And that is called what? An accrued expense. The other item is capital or equity. And capital or equity is the proportion, or it is a portion of the company assets that a shareholder or the partners own. Why are we talking of a portion? This is because, like we have said, We have liabilities. Liabilities is what you owe people. We have assets is what belongs to you. So when you less assets minus liability, whatever remains is capital. That is what actually belongs to you once you pay all the debts that you have. And that's why we are saying it is a portion of the company assets. So it's that portion of the company assets that you own. And we have various equity accounts. We have owner's capital, we have owner's withdrawals, we have revenues, expenses, common stock, and paid in capital. We are going to look at that later when we look at an income statement. You meet most of those items. So for us to be able to prepare a balance sheet or a statement of financial position, you need to understand some key things. And one main thing and one particular area of reference is the bookkeeping equation. The bookkeeping equation is what will guide you in the process of preparing a statement of financial position, or what you're calling a balance sheet. And like we have said, according to the bookkeeping equation, assets equals to capital added to liabilities, whereby assets are of two types. We have the non-current assets and we have the current assets. Then we have capital and we have non-current liabilities, and we have on the other side we have current liabilities. So when you're preparing the statement of financial position, you start from this point here. So the first item to appear will be what? The non-current asset. Non-current assets. Remember, you said assets are divided into two: non-current assets and we have current assets. So you start with the non-current assets. So a standard statement of financial position, we have three columns. The first column is the cost column, the second one is accumulated depreciation, and the third one is the net book value. What do we mean by that? These three columns are meant to take care of non-current assets. Non-current assets are items like buildings, vehicles, furniture, fittings. So you find that these items are prone to wear and tear. When you use them, they lose value, they depreciate. Depreciating is the loss of value due to wear and tear. When you use a car, if you bought a car at 50,000, after a year, that car will not be worth 50,000. Why? Because it will have depreciated maybe by 10%, which is 10,000. So the value of that car will be 40,000. So that tells you that the car value will be 50,000. That will be the cost, but it will have depreciated by 10,000, and therefore its current value will be what? 40,000. That is basically what we are saying, that the cost is the acquisition price. Then the accumulated depreciation will include, one, the depreciation for that particular item, plus any provision for depreciation. A provision for depreciation, if you suspect, or if based on previous experience, you know that this particular asset depreciates at this particular rate, you can provide for that figure in advance, so that when you're calculating your profit, you don't include it in your items. So you provide for it. So that provision is normally added to depreciation for that particular year, giving accumulated depreciation. That is why it's called accumulated, because it combines the provision for depreciation and the depreciation for that particular year. So when you subtract the depreciation from the cost, whatever you get is the net book value, NBV. Net book value is the value of that asset at that given time. That would be the market. If you were to sell the asset at that time, that is the value that you could sell that asset at in the market. So if you have these as your non-current assets, you have land and building, that would be the value. Then this is the depreciation. Then you subtract. When you're subtracting, you put it in a bracket. Subtraction in accounts, whenever you're minusing, we normally use a bracket. A bracket in accounts means subtraction. So you're minusing that to get that. Then land and buildings, plant and machinery, the same. This is the value, minus that to get that. Then you go to fixtures and fittings, the same. Then you go to motor vehicle. Then you can get the total cost here, that the cost. When you put a single line like that in accounts, it means addition. So when I see this, I know you are adding the figures above it. Anyone who have done accounts can tell that you have added these figures. So you get the total there, you get the total here. So that means this total minus this total here will give you the total on this end. So we are done with the first item in the bookkeeping equation, which is the non-current assets. Second item is the current assets. So we go to the current assets. That will be the next item to appear. Current assets, these are items including stock or inventory. Now from this point, the three columns, the cost, accumulated depreciation, net book value, are not going to count. From this point, we are going to use the columns for adjustment. We're only going to use them for adjustment. That is for addition, so that our work can look neat. Not that necessarily, I hear of students asking, why are we depreciating inventory? No, we are not depreciating inventory. We are not. If you see me writing the figure here, it does not mean that this is the accumulated depreciation for inventory. No, these three columns are meant to take care of what? Non-current assets. Now from this point here, you now start using the columns to adjust, just for adjustment. So I'm going to get the total of my current assets here. So I have stock, it is there. I have debtors, the value. I have cash book, I have cash at bank, and I have cash in hand. I get the total here. So the total, I take it to, this is the total. Then I add, sorry, this was the total here. I forgot to put that. So I add total asset, total non-current assets. I'm going to add the total current assets. When I add those two, I'm going to get the total of assets. That is what we are calling what? A total assets. So total assets is made up of non-current assets plus what? Current assets, which is going to give me this figure here. That will be the figure there. I continue. The other section, we go to capital. Now, this side, the equal to this side. So this side here represents the financed by section. By financed by, I mean, this business was financed by what? It was financed by one, capital. Capital is owner's contribution. Whatever the owner of the business has contributed to that business. Liabilities. Liabilities is whatever the owner has borrowed. So the business was financed by those two items, capital and liability. So we move to financed by section. So under financed by, the first item is capital. And like we have seen here, we have capital. So the first item is capital. We have it here. So we put the value here. Capital is normally affected by two items, only two items. We normally add the net profit. Net profit is gotten from the income statement. You check from my other tutorials, you'll find a very nice tutorial on how to prepare an income statement. Once you prepare an income statement, or what we call a statement of comprehensive income or a trading profit and loss account, you're going to get the net profit. If you have a net profit, you add it to capital. If you have a net loss, you less it from capital. That is why we are saying add a net profit or you less a net loss. Remember, subtraction means you put it in what? In brackets. Another item is drawings. Drawings is whatever you take from the business for personal use. You have a shop, you take sugar for your family to consume. That sugar is not paid for. Therefore, it is going to reduce your capital because it has been spent out. But if you are taking an item for business use, right? You are taking sugar to cook tea to sell. That is a business. Therefore, it is not a drawing. See that? So a drawing is what is taken for personal use. Again, that is going to reduce your capital. So you subtract it. That's why you can say put this figure in bracket. So you get the total. The total is there. Then from there you move to what? Liabilities. And liabilities are divided into two. We have non-current liabilities and we have the what? The current liabilities. So we start with the non-current liabilities. You put the non-current liabilities. Let's say we have 10-year loan, we have debentures. Get the total, put the total there. Then you move to the last item, which is current liabilities. So you move to current liabilities here. current liabilities, you have bank overdraft, you have creditors, you have prepaid income, you have accrued expense. As you can see, I'm using this column so that I can get the totals, and then I take the totals to the last column there. These columns, I'm using them for adjustment. After that, I'm going to add all these items. So I'm going to add, so I put a line here to show that I'm adding this plus that to get a figure here. Now, this figure here, from this equation, we are saying that the total here should be the same as the total here. What does that tell you? That this should be a balancing figure. A balancing figure in accounts is normally represented by a double line. So you're going to draw a double line here. Double line means this figure, there is another figure that is the same as that. So I'm going to put a double line here. So this is a balancing figure. The total on of the financed by section and the total of the assets should be the same. So remember, this is one statement. It's only that my page is small, so I have used 2 pages, so it should be continuous. From total assets here, you should continue downwards, and whatever comes after that is financed by. So it's just a continuation. It's 1 page, so you end up at this particular point. This is the vertical format of a balance sheet, and it is a standard format that is used when you're preparing a balance sheet at any given point. This is a standard format of a balance sheet. So having understood that, let's look at an illustration and see how you apply the concept. Illustration is saying John has a business that has been trading for some time. You're given the following information as at 31st December 2014. You're given this information required. Prepare a statement of financial position as at 31st December 2014. So for you to be able to prepare a statement of financial position, remember what we have said. You need to take care of what? The bookkeeping equation. That's something that should be always come in mind whenever you're preparing a balance sheet. And the bookkeeping equation states that assets equals to capital added to liabilities, and assets are divided into 2. We have non-current assets and we have what? Current assets. Then on the other side, liabilities are also divided into 2. We have non-current liabilities and we have what? Current liabilities. So we have current liabilities there. So having done that, we need to identify these items. So we have building. Building is a what? Is an asset, and it is a what? A non-current asset. So this one is a non-current asset. You do the same. Furniture, it's also a non-current asset. Motor vehicle is a non-current asset. You go to stocks. Stock is a current asset. You go to debtors, it is a current asset. You go to cash at bank, it is a current asset. Cash in hand is a current asset. You go to creditors, is a current liability. It's a current liability. Capital, that will go straight to capital. Then we have 3-year loan, which is a non-current liability. You have identified the item, then you're good to go. You put now the items in order, and we have said you follow the same order when you're preparing these. Assets equals to capital added to liabilities. So when you're preparing the statement of financial position, you start with what? Assets. And assets are divided into 2. We have non-current assets. So we start with the non-current assets. So we have building, we have furniture, and we have motor vehicle. Building is 22,000. Motor furniture is 11, and then motor vehicle is 11,600. That is the cost. You put there, you have the total as 44,600. Then we don't have any depreciation, so this will be a dash. Then the net book value therefore be 22 minus 0, 22 11 minus 0, 11. Then you get the total here. So we have the total here. Then we move to what? Current assets. So current assets, we have what? Current assets, we have stocks, that is 17,000. We have debtors, 11,200. We have cash at bank, 3,000. We have cash in hand, 800. Get the total. Take the total there, which is that 2,000. Then these two should make up what? The assets. This is what makes the assets. So we add these two. So we add 44 and 32 to get what? 76,000. So because that is a total, I have to close it like that so that I don't include it in the other values. Then from there, I move to the other side. Capital is what will follow. So capital, that is under financed by section. So capital was 61,600. We don't have drawings, we don't have net profit, we don't have net loss, which are the items that affect capital, and therefore, because it is the only figure, I'm going to take it straight to the last column. There is no need of writing it here and again putting it here, because you cannot write it twice. So you take it straight to the last column, that is 61,600. Then capital is normally added to what? It's normally added to liabilities. And liabilities are divided into two. We have non-current liabilities. So you start with the non-current liabilities, which we have a 3-year loan of 10,000. It's only one, and therefore you don't have to write here. You take it straight to the last column. Then we have current liabilities. Current liabilities, we have only creditors or the account payable, which is 5,000. It's only one, so you take it straight to the last column. It is a total by itself, so you don't need to add here. Remember, we use these columns for adjustment. We don't have nothing to adjust, we have nothing to add to them, so you take it there. Then this one is supposed to give you a total on this side of the equation, so you take this total here, you take the total there, that is 76,600. Then we have said that this total here is supposed to be equal to this, because assets equals what? Capital added to liabilities. So therefore, this is a balancing figure. You put a double line to show that it's a balancing figure. So this is 76,600 and this is 76,600. Those two figures are balancing. And with that, you have your statement of financial position. Don't forget, when you are preparing a statement of financial position, just to mention, there's something here that I need to mention. Any financial statement that you prepare must have a title. It must have a title. A title is written at the center top. We have, this is a statement of financial position, so it is a XYZ Limited, because this is a format, XYZ Limited, statement of financial position as at 31st December 2020. The reason why we use as at is because this statement shows the position of that organization at that particular date. If you go there on 1st of January 2021, this statement will not be showing the same thing, because there will be new items that will have been acquired. So it shows the position at that particular date. So this is the position of the organization as at 31st December. So it means as at 31st December, these are the items that were there in that given organization. So when you're preparing in our illustration here, when we prepare this statement of financial position, so this is the statement for John, the statement of financial position as at 31st December. So it means the business of John had these items. These are the items that they had as at 31st of December. So when you go there on 1st, maybe they are going to acquire new stock, maybe they are going to make some sales, so the position will not be the same. So this one shows the non-current assets, the current assets, the capital, the non-current liabilities, and the current liability that they have at that particular date. That is why it is written as at, because it gives the position of the business at that particular date. This was Virtual Wisdom Finance and Accounting Tutorials. My name is Peter and I was your host in this tutorial. I hope this content was useful. If it was useful, kindly do me some favor by subscribing to this channel. Click on the subscription button. Let your subscription count. As we check next time, let's look at a different figure of a different number of subscribers here. That is the only way you can appreciate the good work that I'm doing. Subscribe to this channel. Also, don't forget to click on the bell icon so that you can be notified anytime I upload new videos, anytime there's new content that is of great use to you. Like the videos, share with your friends, and comment. If you have a question, drop it here at the comment section and I'm going to respond to it as soon as possible. Thank you for your time. Thank you once more. Bye.